Hi, welcome everyone to this week's BitSilk Macro Briefing. The day is 27th of July 2020, and today we're going to cover the price action and news flow for stocks, FX and commodities, and also look at the news flow for policy responses and COVID-19. So, quick disclaimer. This information is for education and training purposes only. Okay, so let's start with stocks. The S&P edged higher again last week and is still broadly bullish. There's a lot of vested interest in keeping the market going higher right now. So as we all know, until the election day over here, the Fed doesn't want to be seen crashing the market. And Trump obviously wants the market to go higher too. What happens after this date, we don't really know, but at least until then, the Fed's still dominating the market narrative and the bias is still to the upside. That being said, I think we are due a bit of a correction. So we had this down move almost immediately after the last macro briefing, where I warned we might get a bit of downside volatility because of the lockdown re-rolls that were happening around that time. And then since then, Jay Powell's money gun has blasted the markets higher. However, now we're reaching quite an interesting level, in my opinion. So we have the February breakaway gap here. And if you don't know what a gap is, so a gap occurs because of order imbalances. So before the market opens, you'll get a lot of traders that either want to buy or sell at the open price. And in this case, they likely realized, this was in February when people were realizing, Corona is a big deal, I better sell my stocks. So there was an imbalance to the sell side. And then the market maker needs to pair up the buys and sells. So it needs to drop the price until someone was willing to buy. And that's where the market opened. But in between the prior close and the latter open, there's no trading. So that's why we have a gap there. The most important thing is with unfilled gaps, they act as a magnet when price is close. And then once the gap is filled, they act as key support and resistance levels. And you can see that's what happened over here. So that's factor one. We have a very meaty breakaway gap right here that is likely going to get filled and then act as a key resistance level. Factor number two is look at the put-call ratio. So the put-call ratio is a technical indicator that demonstrates investor sentiment. And a put or a put option is the right to sell an asset at a predetermined price, and a call option is the right to buy an asset at a predetermined price. And if traders are buying more puts than calls, it signals a rise in bearish sentiment. And if they're buying more calls than puts, then it suggests that they might see a bull market ahead. So they say a falling put-call ratio approaching the 0.5 level here. They say that's a bullish indicator. It means more calls being bought versus puts. However, when we get to these extreme levels here, the put-call ratio works much better as a contrarian signal. So from a contrarian perspective, a put-call past this zone in these extreme levels suggests that investors are overly bullish now and the market is due a correction. And you can see that's what happened over here on the flip side. So investors got overly bearish at these lows, and then soon after the put-call ratio moving average peaked, you had a market that flipped to the upside. And I like to put a moving average on it. And this is because this is just a moving average of the put-call ratio, and this is just to smooth out and make it more legible so that we can see and smooth out these fluctuations, because it's quite hard to read. And we can now see on the moving average that we're at these extreme lows, which is a contrarian sell signal. So that's stocks more broadly, and they could have downside in the next week or two. More specifically with tech, of course, tech is much stronger. But that being said, if the S&P drops, I expect some sort of a pullback in the NASDAQ too. And even better from a trading perspective is the KBE banking index. And this is already looking much weaker, and of course will drop if the broader market does too. Within this sector, iFinancial Pod we already have a trade on TCF Financial Corp. I recommend you check out that video if you haven't already. It looks like a really high conviction trade. So let's take a look at Forex now. So if we have a look over here, get the DXY dollar index up, we can see that the dollar just got absolutely decimated in the last 2 weeks. It looks very bearish. Have we topped out yet? I'm not sure. It's too early to tell. So we have currently the top is over here in December of 2016. Momentum is increasing, but I'm not sure from a short-term perspective whether we're going to see more continued downside or a bit of a correction. Personally, I'm looking for opportunities on the commodity currencies and euro this week. So the euro had this beautiful rally after the 750 billion euro relief deal was struck. And I made some very nice scalps on euro pound last week trading that rally. There's still a lot of technicalities to negotiate. So the question with the euro is, can the EU fudge it? Can they fudge some sort of relief package successfully across all 27 countries? Once again, they still have to negotiate technicalities of what they agreed on last week, and people are very still on this. If anyone watched Sean's interview with Julian Bridgen, I highly recommend watching that when that comes out. And last week, even Julian, who's an expert on macro, said he's quite still on the euro. What I am seeing is quite a few things coming together at the right time for euro. So you have Merkel's legacy moment, and you have Christine Lagarde's appointment ahead of the ECB, which was because she's an expert on bailouts and fiscal. So it's no coincidence that they chose someone with her fiscal skill set, moving away from Mario Draghi's purely monetary perspective. And that's basically the EU predicting they saw that they're going to have banking problems, and they've chosen Christine Lagarde because of this. And that's going to help in getting this fiscal deal across. On the other side, you have a frugal for Austria, Denmark, Sweden, Netherlands in a way. But if you do see these deals getting fudged, then the euro is looking to go much higher, especially against the dollar. Okay, let's have a look at the commodity currencies. So this is a weighted average of the Aussie dollar. And as you can see, we've had an amazing run since the March lows. And we're bullish commodities, and one way that gets expressed is in the commodity currencies such as the Aussie dollar, New Zealand dollar, and Canadian dollar. Going to today, we're still long-term bullish, but in the short run, we have lost some momentum here. So in the short run, I'm not so sure, but definitely long run still bullish. Same story with the New Zealand dollar, and also same story with the Canadian dollar. Now let's take a look at commodities. Okay, so this is the chart of gold. As you can see, gold did really well last week, partly fueled by some dollar weakness down here, and the rest attributed to increasing bullish sentiment on gold. So I'm seeing a lot of bullish gold news articles, even in mainstream newspapers like The Telegraph. So sentiment is getting very bullish right now, and it's a trade that makes sense to a lot of people. It's a great trade. We've had a look at all the reasons for the bullish case for gold in our Sandstorm gold pitch, and I think this does make sense to a lot of people. From a trading perspective, silver also looks very interesting. So we had another explosive rally also in silver last week, and at some point that was around 100% increase since its bottom in 2020, and you can think of silver as a higher beta play on gold. So silver levers gold's movements both to the upside and the downside. And what's interesting about silver is if we zoom out a bit, we can see that gold's already near at these highs. However, silver has a lot more catch up to do. So there could be some interesting opportunities here. Next up is crude. And crude might struggle in the short run, but it's still long run bullish. So again, anything that's dollar denominated is looking very bullish over the next, let's say, 5-10 years. So if we switch to the Reuters commodity index and look at the big picture, we can see that, well, commodities are traded in dollars, so they have an inverse correlation with the dollar. So we can see that as the dollar goes down, broadly commodities go up, and the same is true when the dollar was increasing, commodities had a steady decline. and we look to be at an inflection point right now. So there could be some great opportunities in commodities to the upside, granted if we have topped out here. And now finally, let's just take a quick look at bonds. So the 10-year yield, here's a 10-year yield, and it hasn't moved much from this box since the last update. It's still sniffing out the all-time lows, and it's still pricing deflation for now. And another way to think of this is when yields are this low, it's like the market saying to the Fed, okay, it's okay what you're doing, keep printing, keep borrowing. But if you were to start to see inflation to pick up, then people will start losing confidence in the Fed's ability to control inflation. And then you might see this yield go up, and investors are basically saying, okay, Jay Powell, you've taken it too far. Inflation looks out of control. I'm moving away from fixed income. But for now, we're still in this tight box. And that covers the chart. So let's check out the news. Okay, so pensions. Recent data shows significant pension underfunding in the midst of a crisis, so this is quite alarming. And pensions have been struggling to make return targets on bonds. And this gives incentive to move up the risk spectrum and increase more equity exposure. So recently, Ben Meng, who's from CalPERS, which is the largest national pension fund in the USA, he said, I'm going to move more money into private equity because they only had a 4.7% return last year. So these guys have already said they're going to start using leverage and fly out on the risk spectrum. And their equity portfolios have done very well now since the March bull rally. So what does this mean for stocks? Well, it means that pension flows into stocks are going to start bidding up the price as well. So that's one other bullish factor for stocks. Next, there was some trade tension escalation between the US and China. So China ordered the US to close its consulate in the Chengdu province. This was as retaliation to the Trump administration doing the same thing to the Chinese consulate in Houston. And this is likely bearish for the dollar. Next, we have some positive news. Biocon have approved treatment to fight psoriasis, and this fits the broader trend that we're getting better and better at treating the virus. Also, President Trump held a coronavirus briefing for the first time since April to acknowledge the outbreak has grown in its severity. He said that it will probably, unfortunately, get worse before it gets better, and then went on to list a few policies such as social distancing and masks. Another key event that's going on is the US, their negotiation in the next relief package. So the Senate Republicans and President Trump are trying to smooth out some of their differences for a new relief package, and this may be their last shot at mitigating the pandemic's effects before the November elections. This bill has already caused some tensions within the Republicans and the Democrats, and the Republicans' opening bid is estimated to be about $1 trillion USD, whereas the Democrats have vowed to accept nothing less than $3 trillion USD. And there's a really good article in Forbes titled "Stimulus, Here are the Latest Numbers." That details all the specifics. So if you're interested, I recommend you check that out. But yeah, the important thing here is that the extra $600 US a week ends on the 31st of July. And that's Friday this week. And that's more than 20 million Americans getting their income cut in half. So expect something to get agreed on soon because time is of the essence here. Finally, here are the latest daily deaths and case counts. So fortunately, deaths have been steadily declining in the UK and EU, and that's even given the fact that we have a slight uptick in case counts in the EU beginning over here, and also case counts increasing for the UK as well. So this is encouraging news and shows that we are indeed getting better at treating the virus. And although deaths have a lag, you can see that because cases have already started picking up here and death counts are still decreasing, it does look like that the virus is becoming less deadly, and that could be great for consumer confidence and revert behaviors back to more normal levels. Finally, I'm going to finish off with what to watch out for this week. So on Wednesday, we have the Fed meeting minutes. and consensus estimate is leaving the rate unchanged. And then on Thursday, we have German and US quarterly GDP. The US forecast is very low on a minus 35% basis, so there could be some surprise upside there. And then finally, we have China's PMI on Friday, which have their PMIs already recovered past 50, but 50 means conditions are expansionary. And then finally, CAD month-on-month GDP data release, forecast to grow at 3.3%. So that includes our macro briefing. I hope you learned something new today, and thanks for watching.